following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
In this segment, we like to bring in our NinjaTrader ecosystem partners to Traders Workshop. This week is no different. We have a fellow CMT on the show, Dean Rogers with Kase Company. How you doing, Dean?
Doing real well, Tom. How are you doing?
Doing great. So just curious, when did you get your CMT?
You know, it was a little bit of a long journey for me. I started the CMT journey in like probably 07, 08, and then kind of got distracted with some other things that I was doing. And then I finished it up. I finished up the level 2 and 3 in I think I got level 3 done in 19. So I've only been holding my charter for what, 5 years now.
Okay.
But I've been in the technical analysis world since 2000. So the last 24 years. It just took me a little while to buckle up and take the time, or buckle down and get the CMT charter done. But I'm glad I did. It's actually very worthwhile.
You know what, it's eerie how much my journey parallels yours. So it was 2007 when I started, 2008 when I took the second test, and then I got distracted. And it was 2015 when I took the third test and got the charter. And like you, I've been doing technical analysis since 2000. So, it's the beauty of it is you can step away, and my distraction was with a different business unit with baseball. But when you come back to it, you have to maybe get back on that bike and get a few laps around the neighborhood before you can take off. And it is worth it, I think.
No, absolutely. And I think the thing is, it's worthwhile from the standpoint of, my distraction came in the form of family and kids and raising children and, sporting events and everything else. But then at the same time, I had to take a step back. And, I was in the world of Kase Company, in our world of technical analysis, where we do a lot with, our trading indicators that we have on NinjaTrader and those kind of things. But then also, we also forecast the energy markets. So that last section, that Jim and Craig were just talking about, energy futures and everything else, I was, sitting here like, this is perfect, because that's my world. And so we do a lot of Fibonacci analysis and that kind of stuff with our forecasting. And but taking that step into the CMT world and taking the CMT charter, the test, the level 2 and 3 tests, you really get a much more well-rounded view of technical analysis, and it exposes you to a lot more than just the things that I was focused on. And that really helped me broaden my horizons and get some new ideas, some fresh ideas on, okay, these are ways that we can improve our trading indicators, or ways that we can improve, our forecasting techniques, or even my own analysis for my own portfolio, of stocks that I hold and stuff like that. It was like, all right, let's start looking at market cycles and, doing all that kind of stuff. So I think it's a really good thing.
For sure. That's the beauty of it is, and I'll just leave this here. They're very accommodating. The community is very accommodating for improvement, right? So if I see something that, hey, you know what, I have an idea and I take it a certain way, as it's okay, right? RSI, right? J. Wells Wilder published that, but then some other CMTs or some other market technicians said, you know what, here's how we can adapt it to this market. And so that's great. And by the way, maybe we'll look into a feature where if you hear the guest and you want to jump into, maybe we'll have a raise your hand kind of thing in the room. Say, I want to join too, but I know you're an energy expert. That's why it's fitting that you were here today as well.
No, absolutely. I'm glad. No, it's actually very good, because that section led in, I mean, the trading indicators that we have, so we have Case Statware, we have the Case X trading indicators. Up on the screen right now, I have our Case X, or excuse me, Case Statware trading indicator package. And they work on anything, any market that's liquid, and, has a little bit of volatility to it, whether it's equities, fixed income, futures markets, whatever it may be. One of the things is, the founder of Kase Company, Cynthia Kase, she was an energy trader back in the 80s and early 90s. She made her name in the natural gas and crude oil markets. And so a lot of people, and then we also have, like I said, the forecasts and those kind of things that we publish every week and update daily and send out to all of our clients. We also post some stuff on our blog. I do a post once a week on our blog for natural gas, crude oil, and then gold. But so Cynthia, or Miss Kase, we kind of got cornered into that energy market. But one thing that I do want to make clear is, the trading indicators that we have, they do work very well on just about anything you can plot on a chart, as long as it's something that's, fairly liquid and has some movement to it, some swings and things like that.
Right.
So yeah.
So maybe we could walk through kind of I think you call it KEES, KEES.
Yeah, KEES, yeah. So
KEES, yeah.
Yes, sir. So KEES stands for Case Easy Entry System. And so what KEES is it's our entry tool for looking for trade opportunities. And a lot of what Case Statware does, and our trading indicators do, is we try to take a lot of information from various trading indicators, whether it's RSI, stochastic, our own KCD or Case Peak Oscillator, True Range. We were talking about Wells Wilder and True Range. We use True Range all over the place. And we take all of that information. We even use multiple time frames or bar lengths. And we distill all that information down into these color-coded dots that you see on the bars. Now, hopefully we can see these. In fact, what I'll do here, let's zoom in a little bit. So basically what we have is we have these color-coded dots on each bar. And what these color-coded dots are telling us is they're telling us the underlying bar permission, whether the bar is permissioned long, i.e. the market's going to continue to go up, or short, i.e. the market's going to continue to go down. So it's a little bit of a filter, but it's also telling us some information about the direction of momentum. Okay. So what we're doing with KEES at the base level in the background is we're looking at 3 different trading indicators, or 3 different momentum oscillators. We're looking at the RSI, a refined stochastic. So it's a stochastic, but we have kind of our own spin on it. And then our KCD indicator, which is one of our second derivative momentum indicators, very similar to like an MACD. Okay. And what we're looking to see is whether those are permissioned long or short. Is momentum rising? We basically look at, like, for instance, the RSI against a 9-period moving of itself. And we look to see, is the RSI above its average? If it is, then it's permission long. If it's below the average, it's permission short. Does that make sense?
Well, you know what? That's interesting you say that, because Jim will be great, happy to hear that, because he does have an RSI with a moving average on it. I've never used it that way. But that's really interesting, right? You're using that smooth version of the data to see, are we above or below that smooth version, and coming out with a bias, right, or a directional bias from it.
Exactly. So we're getting a directional bias by looking at that smooth average and whether or not the RSI is above its average or below the average, to tell, okay, is the RSI, is momentum on the RSI increasing, or is it decreasing over a given period of time, right?
Right.
And then same thing with that stochastic, the stochastic, we've got the slow K, the slow D. You're basically looking to see, is the K above the D or below the D, to give you permission on the direction. And then with the KCD, the KCD in and of itself is basically the Case Peak Oscillator, which is looking at, it's basically looking at market momentum. We'll get into the Case PO another time, because that's an interesting conversation on how it calculates because it uses a variable look back length. So we're not using a fixed look back length. But anyway, the KCD is looking at an average of itself, or an average of the Case PO less itself, to give you the KCD value. And then we're just looking to see, is that positive or negative? So if momentum is above the zero line, it's permission long. If it's below the permission line or below the zero line, it's permission short. So basically we're taking those three indicators and they're either long or short, right? And so we take majority rules. If two of the three are long, then that bar has an underlying long permission, and it's going to have some sort of blue color-coded dot on it, either light blue or dark blue. Now, the light blue or dark blue comes from basically once we have that underlying permission from the three momentum indicators, we're looking at a longer bar length in the background as well. We're looking at a bar length that's basically 3 times the size of the bar that we're looking at. Okay. Now, I'm looking at a range bar here, or called DR range bar, but it's a range type bar. But let's say you're using a 5-minute chart. What we're doing is we're synthetically in the background building a 15-minute chart. And then we're looking at the underlying permission of that stochastic on the 15-minute chart to see, is it permission long or is it permission short? So what we're doing is we're saying, okay, we're trading on the 5-minute, but is the 15-minute moving in the same direction? If it is, then we get a darker blue dot, so kind of the navy blue. If it's not, if momentum is permission long on the 5-minute, but then the 15-minute chart is still permission short, so it hasn't turned over yet, we're going to get the lighter blue dot. So we call those first class, the darker blue, and second class permissions. The lighter blue is second class.
So what's really interesting about that, Dean, is a couple things. One is the obvious different time period analysis, fractal analysis. You want to go to the next kind of, what is that bias on a higher level? Are we trading with the trend or against the trend? Exactly. Essentially, right? Exactly. But what's really cool, I think, taking it another level, is it's adaptive to the underlying chart. So rather than just saying, okay, we're going to look at a 1-minute chart and a 15-minute chart and a 30-minute chart. Yeah. You're actually taking the view of, okay, well, whatever chart type you use, whether it's 5-minute or 10-minute, we're going to go to triple that. We're going to go to a 15-minute or a 30-minute. And that's why I think it's cool, because it is adaptive.
Exactly. And I mean, that's a variable. Like when we very first developed this, we used to use 5 times the bar length. And really what it is, it's a rolling window. So, when Ms. Kase was developing these indicators in the early or late 80s, early 90s, the programming wasn't as sophisticated as we can get now, where we can look, pull in multiple bar lengths and everything else, right? So she had to come up with a way to say, okay, well, if I'm looking at a 5-minute chart, how can I build a 15-minute chart? So what she does is she basically takes the open, high, low, close range over a 3-bar period.
Right.
And that's like a rolling window going forward, right? So it's not truly a 15-minute bar, but it's a 15-minute like snapshot of the rolling 5 or 15 minutes, right?
Exactly. Yeah.
So it's adaptive, but like you said, it's adaptive to give you an idea of, okay, what's going on those longer bar lengths, because we really want to try to trade with the trend. I mean, everybody talks about the trend is your friend, all of these different kind of sayings. And so we really want to try to trade with the trend, but we also want to make sure that we're getting in as early into a new trend as possible.
Right.
And that's always the trick, right? Is trying to figure out, when do we have a turn? When do we have a move? When do we have a new trend starting? So what we do with that is we look at basically swing highs and swing lows. So we have another indicator called the Kase swing indicator, which like if we look at this chart here, this has the Kase swing indicator applied on it. And so we draw in swing highs and swing lows, and that has a variable where you can set it anywhere between 1 and whatever size you want, 10 if you wanted to. And what it does is, like, if you have it set at Kase swing size, let's say 2, you need 2 up bars and 2 down bars to draw in a swing high or swing low. If you set it to 3, you need 3 up bars and 3 down bars. If you set it to 1, it's just 1 up bar, 1 down bar, right? So that's a sensitivities thing. So basically what we do with the trading indicator here is, where was my chart here? Is basically we're looking for swing highs and swing lows. And then, so for instance, when we get this swing low here, hopefully you can see my pointer. As the market starts coming up and we start to see these light blue permissions, so basically that's second class long. So that's telling us that momentum, the majority of momentum is now permissioned long on that bar, but the longer bar length filter is still short.
Right.
that rolling window, right? So when we get that, we get an L. Well, this is our first L on this new move up. So it's kind of a green color. It's basically a warning telling us, it's a warning signal saying, hey, we might have a turn here. We might start developing a new directional trade. Now, an aggressive trader or a scalper, they might take that and buy the market right there, and then set some sort of profit target or whatever else. But if you're swing trading or you're looking to ride a trend, what we want to see is we kind of want to see like an ABC formation. So we do a lot of stuff with Fibonacci wave projections and retracements and that kind of stuff in our forecasting.
Sure.
Or if you're talking about Elliott wave or any kind of wave theory, you basically want to see, wave A up or wave one, and then wave two down as your correction. Well, when that correction takes place, we want that correction to hold the prior swing low, because that's telling us, okay, that's a corrective move.
Mm-hmm.
This looked like it retraced about 50% of that move up, might have been even 62%. And then it starts to move. As it starts to move back up, then we start to see this darker blue color L. So that's telling us that majority of momentum is long. Our rolling longer time frame filter is also long. So we have a first class permission. Plus we had that swing low that held the previous swing low. So now we're in the impulse portion of a wave, right? So you have your A, your B, and C, or wave three, is where the majority of a trend move will take place. That's where you get your extension of, 0.6181, 1.618, so on and so forth, right?
Right.
So when we see that signal, this is where we're actually buying the market, is at that point.
So Dean, just to clear a definition, an
Yes, sir.
impulse wave moves in the direction of the trend versus a corrective wave, right?
Mm-hmm.
So when we talk about wave analysis, whether it's Elliott wave or some other type, there's usually a pattern identified. In the case of Elliott, there's five waves in the impulsive direction, 3
Mm-hmm.
waves in the corrective. And so that third wave that that Dean's mentioning, that third wave is generally, like you said, the most. It's certainly not the smallest, but it's generally the bulk of the trend. And
Right.
that's when you get that indication. That's when you want to be ready to take advantage of that direction.
Well, and that's exactly, to dive into that a little bit deeper. No, you're absolutely right. And thank you for making that clarification. It's basically, this is the period of consolidation, right? Where you're getting wave one up, you get the early adopters, or usually sometimes that's profit taking from those that were short. So you're seeing an unwinding of positions. Then you get the corrective pullback. That corrective pullback is basically those that had early adopted, maybe they're getting out, whatever it may be. Not quite certain yet that the market's going to continue to move up. Then when you get that wave C or 3, that impulse move, that's where you get the biggest, generally speaking. It's not always the biggest, but that's usually, like, especially like in Elliott wave theory, that's your biggest wave. And that's where the smart money, as they call it in the CMT analysis. I always used to laugh at that term, smart money, but they would get into the that's where your smart money is getting into the market, and that's where the biggest part of the move is, and that's the part of the move that you want to be in, because when you get wave 4 and wave 5, that's the late adopters. Basically wave 4 is usually when the smart money is getting out. Wave 5 is when the late money is getting in, and then you have your turn.
Right.
So wave 3 or wave C is generally speaking where you want to get in. So that's why what we're looking at here is basically getting in when we have that impulse move correction, and then basically the big impulse move, wave C or 3. And that's where we want to get into that trade.
Now this is an intraday chart. This is based off of your DR range bars, which is available with, I would assume, with the NinjaTrader case package. Is that right?
Sir. Yes, sir. Yeah. So these are the DR range bars. We talked a little bit about them a couple of weeks ago when I was on. It's a range type bar that basically looks at the high-low range, uses minute bars to build the data historically. In this case, it's a 17 cent. So you basically set the number of points that you want for the bar. And so, the setting here is 17. It's a 17-cent bar. People might be saying, wait, hey, why is that a seven? What's the significance of a 17-cent bar? I mean, this is like the most popular question I get is like, what bar length should I trade, Dean? And nobody ever likes my answer. So, or at least most people don't like my answer. My answer is always, it's based upon like your risk appetite and your trade style.
Oh, sure.
A bar length is you've got to hone in, and that's something that we could cover at some point is picking a bar length, because we've got some indicators that help you do that, that fits your risk appetite and your trading style. But the reason I'm using a 17-cent bar here is my highest bar length, where I would be willing to take the most risk, is a 50-cent bar. Okay. Now, generally what we do, we talked about using that 3 times bar length. That's because, basically you're taking 3 times the amount of risk. So like if I'm trading on a 15-minute chart, that's about 3 times the risk of trading on a 5-minute bar. Meaning this, if the size of my stops, if I'm using something like the standard deviation of average true range, which is what we use for our stop indicator, you're going to basically have 3 times the risk if you go 3 times the size of the bar.
Sure.
Now, when you get to range bars, because the range bars are based upon the high-low range, which is based upon, basically it's a measure of volatility. What you're doing is risk is relative to the square root of time. And I mean, that's a whole nother conversation, right? And I don't want to get too crazy here, but there are people out there that can explain it a lot better than me. But what you do when you're using a range bar is, if I'm using a 50-cent range bar, $1.50 range bar is going to be more risk than, it's not 3 times the risk. It's not a 1-to-1 ratio.
Okay.
What you do is you basically either multiply or divide by the square root of 3. So 50 cents divided by the square root of 3 is 29 cents. So basically the 29-cent chart has a third of the risk of the 50-cent chart. And then if you take and divide 29 divided by the square root of 3, that's 17. If you wanted 5 times the risk, you would divide by the square root of 5, whatever it might be, right? So basically what I'm doing here is the 17-cent chart is the chart that I would start off on to get into trades. Once I'm in that trade, I place my stops based upon this chart. I'm monitoring for exits, like divergences or overbought, oversold signals. But then at the same time, I'm monitoring my 29-cent chart to see if I get permission long signals from KEES again. If I get those L's, those permission long signals, then what I can do is I can scale my trade up to that longer bar length by basically, I'm not doing anything physically. I mean, I could add to the position if I wanted to, but what I'm really doing is I'm just scaling my risk factor up. And now what I'm doing is, instead of having stops based upon the average true range of 17 cents, I now have stops based upon the average of 20, or the average standard deviations of 29 cents, right? So it's basically more risk.
So but really what you're saying is, you're widening that risk, but because you get a stronger bias on the longer term,
right?
You're saying, well, the probabilities are in my favor. I can make this stop a little bit wider because I don't think it'll get there. I think, in fact, the probabilities say we're going to continue in this trade in this direction.
Exactly. That's the thing, is so we start off on that lowest time frame, or that lowest bar length. We find our entry point. If we get stopped out, if the market turns, if we get a divergence, we get something telling us to get out before we get those permissions on the longer bar length. Well, hey, okay, it's kind of like it was a low risk trade, right?
Sure.
It was a low risk trade because our risk is based upon our longest bar length, which is the 50-cent bar in this case.
Okay.
So once I go from the 17, I roll up to the 29. I'm taking a little more risk. I'm doing the same thing. I'm monitoring for exits, stop hits, whatever else, but I'm also watching that 50 cent. And if I get that buy signal on the 50-cent chart, now I scale my trade up to that 50-cent chart. Now I'm at my maximum risk.
Right.
Now I'm at the point where if the market does turn and it stops out, I'm only going to lose what I'm willing to risk, my maximum amount. So it's basically a process of scaling up that risk factor based upon the KEES indicator, where you're getting those permissions on longer and longer bar lengths.
Got it. Got it. So that's a great process. I like the logic that's behind it, right? Start on a smaller time frame, smaller risk, and you will know from watching that smaller chart or that smaller time frame range bar when it says, okay, you can look to see where you expand your risk. I mean, I'm looking at the dark blue in this case. If I'm long, right, I start to see an L there, or I start looking at the dots, then I know something could be changing for a stronger momentum trend.
Exactly. Yeah. Exactly. And that's the thing is that, these indicators, the Kase stat where it's really kind of, it's all based, or not all, but very much based around momentum and market momentum. And that's why it's a really good swing trading tool, where we're looking to get in. I mean, it can work on, the scalping side, getting in and getting out, setting profit targets, that kind of thing.
Sure.
But it was really designed and as an institutional trader, Ms. Kase, when she designed these indicators originally, and we've improved upon them vastly over the years and continue to improve upon them, but their original intention was for swing trading, and directional, holding a position. And it's not so much about the holding time. I mean, because, if I'm trading on a 17-cent chart, I might have a really nice trend during the day. Right. That would be the equivalent if I was trading on a daily chart where I might hold that trade for a month, Right. It's just the number of bars and the chart patterns.
It's the scale, right?
It's the scale, right? And the risk factor is obviously much smaller when I'm trading on lower bar lengths. So the idea though is these indicators are very much based around momentum. And that scaling process is something that I really like, because what it does is it helps me to get into a trend early, and then start to scale the risk up as that trend is developing on longer and longer bar lengths, and not miss that early portion of a trade in a new trend.
Right.
Right. The idea is that I'm really, in this case, trading off the 50-cent chart. That's where I want to get. That's my goal, is to get the trade up to that 50-cent chart. But I'm starting off, or I'm trying to trade the trends on the 50-cent chart, right? But I'm starting off by scaling my risk in, or my trade in, on the 17-cent chart, and then scaling that up over time.
Love it. Dean, we've run out of time, unfortunately.
No problem.
These things happen. Where can people find you real quick?
So best place to find information about us is on our website, kasco.com. So KASECO.com. All of my information's on there as well. You can find us on LinkedIn, Facebook, Twitter. It's always at Kaseco, KASECO. And if anybody has any direct questions for me, they're always welcome to email me. It's dean@kasco.com.
Awesome. Thanks so much, Dean, for coming on. It's always a pleasure having you on. We'll do this again in a couple weeks.
That sounds good. I look forward to it.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.